Hi, everyone. Good morning. Thank you very much for coming to our panel. The topic is about opening up China's capital markets. I actually, from yesterday, there have been plenty of discussions about that, and but fortunately, we have a very distinguished panel of speakers coming from very different backgrounds, and hopefully we can, offer additional insights to offer you that might be helpful. I would like to introduce our speakers first. I think among us, we actually all grew up in China and worked both in U.S. and China as well. So I'm actually a quant PM for much of my professional life. So except for 2 years, I manage hedge fund investment for China Investment Corporation. So I actually have the least China experience. So that's why I'm the moderator. They're the speakers. Okay, so. I'm just go, in alphabetic order. So the first is actually my good friend, Tommy Fang. He actually comes all the way from Hong Kong, and he's heading UBS China Equities business, and recently also added the fixed income business to his team. So we know that UBS is the first and still largest qualified foreign institutional investor in China, and have largest market share for the stock connect. So Tommy actually regularly interacts with regulators, industry experts, and the media to help promote the reform in China's capital markets. But also he has over 100 people reporting to him, so he commands a lot of resources. So if you need his help, Daju, who sits next to me. And he is the chief operating officer of tFOSE, a Toronto-based exchange, derivative exchange. So they actually have big plan to launch some products, futures, options, swaps that's actually linked to China's capital market indices. So that's potentially will be another way for you to invest or have access, or do risk management about China, from overseas, hopefully. So that's their big plan. But just exchange is probably better businesses than hedge fund right now, given the declining fees, right? So Robert is coming from China directly, and then Robert is the CEO of one of the largest macro hedge fund based in China, and Jim already mentioned the Fangtang in Hangzhou, and I mean, I don't know, 5 or 6 years, they have such a tremendous growth. I mean, they attract a lot of managers and AUMs. So the Fangtang is actually modeled after Greenwich, Connecticut, hedge fund industry. But except they have lower taxes, so that's why they're growing so fast, I guess. So. Yeah, the Dr. Han Wang coming from Industrial Securities, one of the largest security firms based in Shanghai, and he is a very, very good macroeconomist, and he regularly interacts with the regulators and the government agencies. So he's a expert on monetary policies, government policies. So we all know in China, one big difference is that the government does play a much bigger role in the economy, in capital markets, than what we probably are used to here. So he can give us a very good perspective on that, and why China is opening up the financial markets, and what's the sort of near-term macro policies and the drivers for the capital markets. So yeah, that's a brief introduction. So let me just say this. I think if you're an asset manager, if a global asset manager, you cannot afford not to invest in China nowadays. So to me, it's almost like you're saying, well, we could afford not investing in Europe. That's how big Chinese market is right nowadays, right? The second largest equity market in the world, third largest bond market, and they're opening up the futures market. There's a number of ways of doing that. And they're also opening up pretty, well, I say pretty fast. I'm meaning by the China standard. So some of you may still think it's slow, but I compare to my own experience like 10 years ago when we're trying to open an office in China, and the things we could do there is close to none, basically, right? But now you can. There's so many ways of doing things there, and also it is sometimes difficult to understand China. I say it from my personal experience. Even I grew up in China, but after I stayed in US for like 3, 4, 5 years, and making some trips to China, I start to feel like, I don't know China that much anymore. So it's just different. But it's because it's different, it gives you a lot of diversification benefits, right? So we will know about home investment bias. If this is how you get the diversification. And besides all the alpha opportunities in those markets, which are much less efficient than what we see here, and we know how it's hard to beat S&P here. And but there, if you look at a lot of local managers, I mean, the performance gap over the index is huge. We're talking about 10, 15, 20% per year for 10 years consecutively. So you will see this kind of returns. It's because it just much less efficient market. You're going to see a lot of opportunities if you do things right. So, okay, so without any further talks from me, so let me just hand it to Tommy first, and he will give us an overview first about various channels to invest in China, pros and cons, and he got a lot of examples of that. So, okay, please.
Well, thank you, Dr. Lu. Good morning. It's a pleasure to be here with the distinguished panelists and all the audience. So I've been in the industry for 20 years. It was Goldman, Morgan Stanley, but UBS is really I spent most of my career. So I still remember back in 2003, 2004 when I commute between Manhattan and Stanford, the UBS headquarters. Always very proud to see the logo when I get off the train. So in some way, I feel like Connecticut is my second home, away from China. So it's definitely good to be here. Dr. Lu mentioned in terms of opening and also in terms of access platform. So before that, I just want to share with all of you, one of the view I've been promoting in terms of the 3 key trends for Chinese capital markets. The first being internationalization, and the second is institutionalization, and the third being innovation. So I hope I get to talk a little bit more for the second and third. Just to begin with, for the internationalization. So with the symbol of some of the policy mechanism, especially for example 2016 when China complete the Stock Connect program. So in my view, it's really opening up potentially the golden decade for capital market opening for China. It is the second largest economy with $8 trillion US dollar equity market cap and $13 trillion US dollar bond market cap. They have the depth and the breadth to adding to the investment both from alpha and a beta perspective. But it just opened up, especially from for market participants like ourselves being in there, really pushing through the opening since early 2000. But really 2016, 2017 really pick up the speed. We have seen foreign ownership for the markets has grown from 2% to somewhere around current 4 to 6% based on different measures. But this is really far from any sort of mature capital markets foreign ownership, somewhere between at least 10% to up to 40%. So this creates huge opportunity for global managers to look for alpha and diversification on a global basis. But internationalization is not only global investor coming into China, but also for the wealthier, high net worth individual and the institutional investor domestically in China, really looking beyond their home country and diversify their asset class to the global markets, which will potentially adding to a lot of the positive dynamic into the capital markets. In terms of the overall access into China, so there are many ways. I would just simplify it and narrow down to 3 platforms, which probably most relevant to the audience here. The first is QFII. You apply institutional investor status to invest into the China capital market. And the second, which is really picking up the steam, is the Connect programs, either Stock Connect or Bond Connect, primarily through the platform from Hong Kong. The third, which is increasingly focused by global managers, is the WFOE, wholly foreign-owned entity, where you can set up your research and investment vehicle in China. So using an analogy, so the QFII is more like you apply for sort of a frequent visa to China. You establish that relationship and the status to go there. And the Connect is more, you still travel through Hong Kong, a very developed capital market, if you will, have that convenience, but also a bit of a distance in terms of how do you access. Whereas WFOE is really, you apply a local ID and really set up some of the status onshore. But just to share with all of you some of the data and the pros and cons, I think for QFII and the Connect combined, now global investors' ownership into the equity market now is roughly about $270 billion US. So that's, depending on how you measure the free flow, it's close to 6-7% of the whole market in terms of the free flow ownership. 6-7 still sounds relatively small, but that's already on par with the domestic mutual fund ownership and also insurance company and a local pension. So global investor is playing a very important role in terms of investment style, putting more emphasis around governance and also transparency of all the listed company. So this is really increasing steam. And also QFII really give you the full access beyond stock and a listed bond market, but also you can invest into the IPOs, the tech board, and the participate blocks, and all the other instruments around the domestic capital market. But for Connect, it's really where I would say the heaven of global quant, where they're looking for globalize their strategy into the China space. If you look at the overall turnover, so now Connect already command somewhere between 6 to 7% of the whole market turnover. And with the overall turnover ratio, people have this notion, domestic stock market for China have a lot of retail, they churn quite a bit. But if you look at Connect, the overall average turnover ratio is about 3% daily, which is triple of the overall market. You can see a lot of the more high frequency type of quant manager are really finding the return and the strategy working into the China market through the Connect scheme. So that's where a lot of the focus has been in this community among the quant manager. Last but not least, just to share some data in terms of WFOE. So that's how you set up a local, global, foreign-owned managers onshore. So since 2016, the scheme started. So now there are 22 global houses. Those are public information, including the Lonely, BlackRock, Vanguard of the world, but also DE Shore, Two Sigma, most recent. 22 managers already set up local presence and started to make investment, raising funds in China. So far, it's just the beginning. 56 products onshore have raised $1 billion. I can definitely see that continue to grow.
Yeah, thank you, Tommy. That was a great discussion. So yeah, let's turn to Robert. Just to give us some local perspective, truly local perspective, as one of the largest hedge fund managers in China.
Okay, thanks, Bill. Yeah. Actually, this is the third time for me to be here in Delaware Hotel. Actually, it was back about 6 years ago when the Chinese government legalized the hedge fund sectors. Provincial government of Zhejiang province, they want to build a hedge fund town like what we have here, Greenwich. So that they let me lead an official delegate visiting here. Government officials from provincial government and municipal government, and as well as district government over there. And since that period, actually, I think it's for the first time in 2015, the Hangzhou municipal government, they have this first ever alternative investment, global investment summit being held in Hangzhou. And James and Bruce, they were there. Since that period, they went to Hangzhou 4 times among the past 5 summits. It was it's just like everything in China. As soon as the government legalized something, it tended to grow rapidly. For example, like back to 2015, at that time total AUM for hedge fund sector, or what we call the PFM, private fund manager, is 300 billion RMB. But right now it's 2.3 trillion RMB, with about 8,800 private fund managers in China right now. So you can see the private fund managers has been playing increasingly important roles in China's capital market. Just like Tommy said, foreign investors right now, they account for about 6% of the total market cap. But back to 2007, at that time, mutual fund is the single largest market player. It accounts for about 20% of the total market cap. So by the end of this first half of this year, foreign institutional investor accounts for about 6%. Mutual funds accounts for about 6 to 7%. PFM account for about 6%. So different institutional investors are starting increasing their influence on the capital market in China. But overall, in China, right now there's 123 trillion AUM for all asset management business. So for hedge fund managers, we account for about only 1.5% of the total AUM. But I have been visiting, Greenwich, New York, San Francisco a lot. My feeling is that private PFM in China is what we are right now is exactly what it was for hedge fund sector in the United States back to 2000. Right before and after the tech bubble, a lot of market players enter into this market trying to get their market share. But since the market crash in 2015 for A-share market, the sector starting to consolidate. Right now, for top 25, because in China right now there are only 25 hedge fund managers with AUM larger than 10 billion RMB. The top 25 market players accounts for about 33 or 32 total AUM for the sectors. But just like last year, CRRC, started this opening up of PFM sector to overseas market players. Right now, there are about 21 WFI, the wholly owned foreign market players for hedge fund sectors being approved. Right now, they launched about something like 38 products with a total AUM, I think, by the end of this first half of this year, about 5.2 billion RMB. It's still relatively small. But going forward, I think because I think it's the decision makers in China, they made these determinations to further opening up the PFM sector for overseas market players. So as on the ground market player, I think there are two challenges, is what we have, for foreign market players, you are going to have anyhow. The first one is that overall capital market in China is still retail investor driven market. For example, like if you look at the Sharpe ratio for Shanghai Composite Index for HSCI 300, the Sharpe ratio is only 1/3 of that S&P. The biggest drawdown for the market is about 2 times larger than S&P. And even it is same and true for the bond market. So I think by nature, because of this, the retail-driven market, so the volatility is huge. That's why, like Bill mentioned, there's still a big performance gap for the professional market player versus, the index or the retail investors. Opportunities there. And secondly, because of the it's retail-driven investors, so the regulators in China, they tend to overprotect retail investors. That's why for the development of derivatives, it's very important for us. We need to we need to have a much less drawdowns for our clients. So, but if you don't have enough derivative to hedge your risk, how possible you can have a much smaller drawdowns? So that's why I think, as a local player, we are very much welcome to have more and more foreign players, because we need to work together to educate regulators, for the benefit of this country in the long run. We don't need to overprotect retail investors. They are creating volatility. So this is the first challenge. This is a retail-driven market, and the volatility is huge. You need to have more derivatives to, to decrease your drawdown. And secondly, for all of the, 8,800 PFMs in China, I think 80% of them are equity long strategy. And for most of us, our clients are from sales channel of a banking system. You don't have much access to your client. You have to sell your product through banking system. So I think this will be much difficult for foreign players, because how possible so many high net worth individuals in local market. Just like us, we are in Zhejiang province. Zhejiang province ranked number 2 in terms of total number of public listed companies in China. Number 1 is Canton province. They have something like over 600 publicly listed companies. Whenever you have so many companies, you have a lot of high net worth individuals. But in Zhejiang province, we have over 400. But for us, we are local players, so we have our ways to connect with our clients. But it will be much more difficult for foreign players. That's second challenges. Yeah, that's pretty much for me. Thank you.
Okay. Yeah, thank you, Robert. I actually forgot to mention Robert is also the director of Asset Management Association in China. I think it's similar to FINRA here, and he's also chair of the hedge fund committee. So he's very, he knows all the rules and the regulation of how about to set up WFI and asset management company in China. So if you like to set up his fund time, so please contact him. So,
yeah.
Okay. Yeah. So I want to turn to Dr. Wang to give us more macro perspective on policy aspect, because we know the government policy regulation are so important, more important in China's markets, and why they're opening up. Is there any possibility of reversal policies? And please, yeah.
Sure. I mean, is the mic working? Yeah.
Oh.
All right. So it's an honor to be here. My name is Wang. I'm the chief economist of China Industrial Securities. We are a Shanghai-based investment bank. And so since I'm the only macro guy, so I'll talk more from the top-down view. I think that the key words of this panel is opening up and also capital market. And so during my roadshows, many roadshows with foreign investors, usually the questions are, why opening up? Why now? What's different this time? And why capital market? And so I would like to share 3 observations you may find interesting. The first one is for last October, the October of 2018, China's Communist Party have a quarterly meeting about economic situations. And the meeting is only attended by the political bureau members, which are the highest ranked 25 members of the party. So for the first time in 97 years of the party, the word capital market appeared twice in the official statement after the meeting. And then only 5 years later, in February of this year, all these 25 members of the party get together, study the importance of the capital market of China. We haven't seen that for, like I said, almost a century. The second observation is that in the March meeting, annually we have a March National Congress meeting, and so the Premier of China, in his entire report, there was one sentence saying that from now on, we need to keep the pace of monetary supply growth at the same pace as nominal GDP growth. Now, let me rephrase that. When we talk about money supply, on one hand, it's the asset of the banks, right? On the other hand, it means that we we are sending out money, lending money to private sectors. So when they say the money supply growth need to on par with nominal GDP growth, that's another way to say China want to look at the debt to GDP ratio. Just a fun fact, 10 years ago, if you look at the BIS number, China's debt to GDP ratio was about 100 percentage point lower than the US level. What is now 5 percentage point higher than the US. So that's another interesting fact. The third one is, if you look at all the statement within this Sino-US trade war debate, China has been using different types of tools to basically retaliating. But there's one thing that has been consistent over the last 12 months, which is they're talking about opening up. And so you put all these three together, what this tells us? One is that the capital market is really, really important to China at this moment. And the second one is because the debt to GDP ratio is too high, they have to rely on the capital market. And also, they need to find a way to drive down funding cost for the outstanding debt. And the third one is, while the US is still debating about whether we should decouple with China, China is using a different approach, which I would rephrase as an entanglement strategy. So just one interesting fact. So I got here yesterday, and I just got my new Huawei phone a couple of weeks ago. And so I was trying to see what type of apps are available in the US. And it surprised me that Uber doesn't work on this new Huawei phone. Because it says that you don't have Google Play, so it's not working. Just imagine what's the cost for consumers. For me, I can get my 5G signal in Shanghai anywhere. So I want to keep that. On the other hand, when I got here, I want to take Uber, and I have to pick between these two. So many speakers of the last 2 days have talked about decoupling, but I think China is taking a different approach, which is opening up. So now let me take one step back about why the capital market is so important. I mentioned that one is the debt to GDP ratio is too high, so they need to rely on the other financing channel, which is the capital market. The other one is because we have this huge debate between US and China about technology. So China need to boosting the domestic innovation in the tech sectors. Now, previously, China's business growth model was to rely on investment. So you can get bank loans for home developers. It's very difficult for startups to get bank loans from the banks. While on the other hand, you get cheap money from the capital market, because that's what the venture capital and private equity people are doing. So I think China is trying to solve the three problems, which is debt ratio, innovation, and US-China trade war, with one stone, which is opening up the capital market, emphasizing the importance of the capital market, and also opening up. As long as China is not isolated by the other countries, we are in a good position, because even with a slower assumption of China's growth, China will be the biggest economy of the world. So just imagine 10 years later, when once again, if we have a US-China debate, China is much stronger economically, and then obviously we'll have a better advantage. But in order to achieve that, China cannot be blocked out by the overall market, and financial opening is probably the best strategy they have. So I guess that's why my understanding is that this time is different. The opening up is different, and the capital market is different.
Yeah, thank you, Dr. Wang. Yeah, so my personal experience is this time they're doing things pretty fast. You highlight some good reasons for it, and but the previous panel also. I mean, when I walk in, I actually missed the previous panel. When I walk in, some people telling me the previous panel was a little bit concerned by some risk from investing in China, and just happened we actually we're going to talk about this as well. And Daju Gu, probably from his perspective, what he see about the risk in investing in China, and actually what are available tools or that you can hedge those risks, and hopefully they're also trying to develop some additional tools that you can use to hedge those risks. Please, I'll turn it to you, okay?
Well, thank you. It's a really honor to be here. I want to share with the audience some of my mental observations or notes that draw through probably past 5 years. I've been traveled to China probably 30 times, so quite frequent. Dealt with a lot of institutions, exchanges, and regulators, and so I just want to share with some of the my mental notes. The first of all, everyone talk of a lot of great potentials in different asset class, bond market, equity market, the percentage for room for growth. But I would say, just be cautiously optimistic, and it's not the money on the ground. You just go there, walk on the park and pick up and go. So ask all your colleagues how many of them are really have a great time in terms of getting the return, right? So my point is, I'm obviously all of us are made in China, right? So we spend a lot of time outside the country. We connected to the country very well, industry-wise, personal-wise, right? So first thing I want to say is the capital market in China are really at its infant stage, and that's why it's very inefficient, a lot of opportunities. So first note, from product point of view, it really lacks of the products that you come to used to here in the developed market, right? Couple examples. You look at the futures market, other than the Singapore A50 futures, are there any other tracking A-share futures? None. Recently, we talked about, MSCI A index is ready, and the first one lined up waiting is the Hong Kong Stock Exchange, right? So because of a recent sort of things happened in Hong Kong, that kind of getting a little pause, right? So what I'm saying is the product is not really complete and far from it. Another example, CSI 300 index options, it's 6-7 years in making. And by the way, any product you want to list it, trade it, not only pass CSRI, the central regulator, but also goes to state council. So it's a long cycle. My point, you got to be patient, right? Another example, security lending sector. It's very, very inefficient at all. Anyone who are looking for liquidity, we're talking about loans, all these ecosystems are in the process being built, and it may take quite a while, right? So caution, number one. I would say, you really have a very strong enthusiasm to go, but be clear, be realistic about the returns you expect over the next, 12, 24 months. But I think the market will reward you if you do have patience, right? This is one of the reasons we set up the exchange. We are trying to provide the hedging tools, that we see. So number one. Number two, I would say there is a great need for the market education in China. I think all of you would agree with me, particularly Robert, you deal with the regulator on a routine basis. There's a really misconception of what is really the roles of derivatives, right? They think, recent example, even sort of enhance the fear of the regulator is 2015 market crash, right? People blaming, index futures really dragged down, accelerated the market crash, The truth of the matter of fact, probably not, there's no conclusive sort of.
But this is changing, by the way, so we can use different OTC and obviously exchange product to facilitate that.
But the point is, I think that there's a really need to really set the record straight. What is the role of derivative, use of financial derivative for the risk management purpose, right? So I think, this is another my mental notes. Third thing is, you really need to be understanding the regulatory appetite. By that I mean, the way, the sequence the pace the regulator choose to introduce new product, new regulations, it's really according to how comfortable they are rather than what you expect to, or even the market need. So that was a regulatory appetite. At the same time, those of you who are really enthusiastic to go to invest, you need to do your homework too. What is the regulatory landscape? Which rule governs which industry segments, right? And it's you know, so you really need to have a clear map. And where are you going in terms of leveraging? That may be the wrong words to do, you know, to say, to participate, to develop the market while getting expected return. So where are you positioned there, right? So we talk a lot about the market access. So my point is, perhaps seeking proper partners, local partners, might be very helpful in helping you navigating the webs of regulations, relationships, beyond just simply logistically set up the office. I think I'll leave it.
Yeah, thank you. I think definitely there, for anyone who set up operation in any foreign country, you kind of have to balance out the longer term prospect and and make money in the next year or two. So in particular with China, I mean, a lot of changes are structural changes. That's where the opportunities are. So when opportunity come, when it happens, you really make 100% returns. I have seen hedge funds doing that inside China. After being in China for 5-6 years, it's actually being a cost center, then suddenly become profit center for 2-3 years. We're making 100% return because certain structural reforms happen. And so it's not our smooth process by any means. And you need to invest your time, to invest your resource, to understand the local markets, and find where the source of returns are. And so there's certainly a lot of learning to do. But I think longer term, you look at where asset management industry in China will be in 5-10 years, I think that's a huge, explosive growth potential, and we probably will recognize that. But yeah, hopefully the government will continue, open up and establish more tools, more instruments, more markets for everyone. That that China's cap market will become a much better one as well in the process. So yeah, we have about 3 minutes left. So maybe we should open up to the questions from the floor, please.
So you say the time horizon is 1 to 2 years is unrealistic. You have to be patient. Then you also say that if you can hunker down and spend the time, you can have potentially 100% return. But that sounds probably pretty good to a lot of people in this room. We don't usually hear the triple digits. It's pretty cool. Is there any in between? I mean, one of the things we know that 2 Sigma is opening up a big office in Shanghai, and obviously Bridgewater's been there for a number of years, and it seems like it's the very biggest firms that have the staying power and the capital to do that. Is there an opportunity for more of a mid-size firm to do it? And is there an in-between between losing a lot of money and 100% return?
I'll take a step first. I think the market is big enough for almost all players, and I think one of the CIO pension manager I interact with, he want to share some of the ideas. I think so. I would just quickly put for asset allocator, other than the correlation advantage, there are a lot of market disallocation in China you can particularly pick up. So for example, some of the pension, we have written them outperformance swaps or notes where you can actually participate into the onshore benchmark equity index with a guaranteed performance of somewhere between 5 to 10%. So that makes asset allocator very exciting in terms of not picking the managers or picking a stock. They would just long that asset class with a guaranteed outperformance. And as Mr. Zhang mentioned, if you are hedge fund or even long-only manager, investor into those managers, there's more than 100 very high quality hedge fund and also long-only manager in China. So they're very keen to be your managers and then to work with global pension and the investors. So those are the opportunities which is there too. And if you are long only or hedge fund managers, as I mentioned, quant managers has really deployed their strategies with different signals, with the market depth and retail participation. I think about the success ratio into China has been pretty high.
Another way to participate in this market is that as a local manager has been growing bigger and bigger, like for top 25 market players, I think more than half of them set up their Hong Kong office right now. The reason for them to do that is that for the local managers, there are not many long-term capitals from Chinese high net wealth individual. So just like us and other players, they like long-term investment from foreign market players. But for local players, it's very hard for them to know who is a long-term investor from the United States, Europe, et cetera. I think there's opportunities. Thank you.
Yeah, so certainly, I think my impression, like, if you're a reputable foreign firms, you actually, I think you have some advantage, brand advantages inside China. Because you're coming from U.S. or Europe or North America, where the compliance is probably more mature. So investing in China do appreciate that. It's not like they don't know the difference of some what managers doing here and certain managers in China over there. They could have inadequate disclosure and take excess risk. But managers here tend to have a much better risk management practice, and that's actually our advantage. So when you go to China, it's not just unfamiliarity. So you're coming from US, they have the established track record. People in China actually look at you pretty favorably. So that's my impression.
I would just add, Jim, you want to really, if you're one of them going to the country, you definitely want to hide your intent. You want to make a few quick bucks and disappear, right? So people will probably not really show a very good reception to you.
Thank you.